Hi Raj. Today we are going to talk about shareholder benefits, which is one of the most common problem areas in corporate tax.
I have heard that term, but I do not really understand what it means.
Let us start with a simple idea. Even if you own the corporation, the money inside the company does not belong to you personally.
That sounds strange. If I own it, why is it not mine?
Because a corporation is a separate legal entity. It owns its own assets and cash.
So I cannot just take money whenever I want?
Exactly. You must take money through proper methods like salary or dividends. Otherwise, CRA may treat it as a shareholder benefit and tax you.
So shareholder benefit basically means I got something from the company without proper tax treatment.
That is correct.
I am a bit confused. I am both owner and employee. How does that work?
That is a very important question. You wear two hats in a corporation, one as an employee and one as a shareholder.
Why does that matter?
Because the tax treatment depends on why you received a benefit.
Can you explain that?
If you receive a benefit because you work in the business, it is an employee benefit. If you receive it because you own the company, it becomes a shareholder benefit.
So how does CRA decide?
They ask whether the benefit is available to other employees. If it is only for you as the owner, it is likely a shareholder benefit.
So documentation and fairness matter.
Exactly.
What happens if I buy something from my company at a low price?
That brings us to adequate versus inadequate consideration.
What does that mean?
It means whether you paid fair market value for what you received.
So if I pay less than market value, there is a problem?
Yes, the difference between what you paid and the actual value may be treated as a shareholder benefit.
Can you give an example?
If a property worth $1 million is sold to you for $100,000, the $900,000 difference can be taxed as a benefit.
So everything must be at fair market value.
Exactly.
I often hear about shareholder loans. What are they?
A shareholder loan happens when money moves between you and the corporation outside salary or dividends.
Like taking money for personal use?
Yes, or when the company pays your personal expenses.
So it is recorded as a loan instead of income?
Initially, yes, but it comes with strict tax rules.
Are there different types?
Yes. Either you owe the corporation or the corporation owes you.
So it depends on who gave the money.
Exactly.
How do these loans actually show up in real life?
In practice, they come from everyday transactions.
Like what?
Paying groceries using the corporate card. Paying personal bills through the company. Taking cash from the business account.
So these small things add up?
Yes, and they are tracked in the shareholder loan account.
What does that account tell you?
It shows how much you owe the company or how much the company owes you.
So it is very important for accountants.
It is one of the most important accounts to review.
What happens if I do not repay the loan?
There is a strict rule. The loan must be repaid by the end of the next fiscal year.
What if I miss that deadline?
Then the loan amount is added to your personal income and taxed.
So it becomes like salary or dividend?
Yes, but without planning, which can be costly.
What if I cannot repay?
Then accountants usually convert it into salary or dividends to handle the tax properly.
Is there anything else to watch for?
Yes. If a loan is interest-free, CRA may add an imputed interest benefit to your income.
What if I repay the loan just before the deadline and borrow again later?
That is called a series of loans and repayments, and CRA is very strict about it.
Why is that a problem?
Because the repayment is not considered genuine if you plan to borrow again immediately.
So CRA ignores the repayment?
Yes, and they may still tax the original loan.
So I cannot use that trick.
Exactly. The repayment must be real and permanent.
I also want to understand how vehicles work in a corporation.
That is another complex area. Vehicles are often used for both business and personal purposes.
So how does CRA handle that?
They require you to separate business use from personal use.
What are my options?
Either the corporation owns the vehicle or you own it personally and get reimbursed.
So the choice affects tax.
Yes, significantly.
What happens if the company owns the car?
The corporation can deduct expenses, but there is a catch.
What is the catch?
If you use the vehicle personally, CRA considers it a taxable benefit.
Even if I use it mostly for business?
Yes, the personal portion still creates a benefit.
Are there specific types of benefits?
Yes, the standby charge and operating cost benefit.
So I may end up paying personal tax.
Exactly, especially with expensive vehicles.
What if I keep the car in my own name?
That is often the simpler approach.
How does it work?
You track your business kilometers and the corporation reimburses you using CRA rates.
Is that taxable?
No, if done properly, it is tax-free to you and deductible for the corporation.
That sounds easier.
It usually is, especially when there is significant personal use.
So less complexity and fewer tax risks.
Exactly. That is why many advisors prefer this method. Raj, if you remember one thing from this lesson, it is this: do not treat your corporation like a personal bank account.
Yes, I can see that most problems start there.
Exactly. If you follow proper methods like salary, dividends, and structured transactions, you avoid most tax issues.
Thanks, Alan. This really helped me understand the risks and rules.
Good. This topic is critical for anyone working in corporate tax.